Hey everyone, welcome back to the Mark Loeffler Experience. Today we're going to be talking about recession or no recession. In the words of Lloyd Christmas from Dumb and Dumber, so you're saying there's a chance. Are we headed to a recession? What are the warning signs we need to look out for? What's going to keep us from going into a recession? This is what we're going to drill down in for today, and comment down below. Let me know before we go through all these things. Are we heading for a recession here in Canada? I guess let's talk about a little bit of the background of why we might be heading into a recession. Well, the Bank of Canada, the good old Bank of Canada, decided that they're no longer just in the monetary policy business. Basically, their only job was to keep inflation between 2 to 3%. They're now in the employment business. So when they had stated that they were not going to raise rates because we weren't back into full employment from virus, I think in hindsight, we're going to see that this is not their mandate and it should never be their mandate, and that they should just stick to keeping inflation in check. But that's just me. Anyway, so what are the signs that we're going to look for? Well, number one, inflation. So is inflation ticking down month over month? Or is it going up still, and that's going to cause the banks to go past, say, a 3% interest rate, which we're at, I think we're at what, 1.5 right now. So that would give us 3 more rate hikes of 0.5 this year to get to 3%. But like if we got to, I don't know, 4.75% or something like that, 4.25%, I definitely think that's going to cause inflation, right? One of the other leading indicators of inflation is if you look at long-term bond rates and what they call an inverted yield curve. So if the long-term rates, if the short-term rates go above long-term rates, that's an inverted yield curve. It's definitely a signal that we may have a recession coming up. Just because we have an inverted yield curve, that does not mean 100% that we're going to get a recession. It's just like Lloyd Christmas again. So you're saying there's a chance. So as of right now, Bank of Canada is playing catch up. It is playing catch up on the interest rate hikes. They should have probably been starting to increase rates last September, definitely in January, but then we had another shutdown and then we had a war start. So they delayed. So now we're having it hit harder and faster than we would have if they did more gradual rate hikes previously, which is what it is. It needs to happen. What happens when they raise interest rates is, well, people buy less things because it costs more money to buy things. So, if somebody was going to take out, use their line of credit to go on vacation or to buy a couch or to buy a car or an ATV or something, well, now that money costs more to borrow from your house. So your house isn't the piggy bank it used to be because it does cost you more money. Now, it's still relatively free money compared to, say, 20 years ago? But as in the last 10 years, it's getting to be expensive money. So Scotiabank says one of the principal downside risks is the inflation outlook. Their current forecast for inflation to average around 6% this year and 3% next year. Higher inflation would lead to erosion of real incomes and require higher interest rates, both negatively affecting growth, right? Which I think we've said during this thing already, just in a little bit more roundabout way. So using their macroeconomic model, we estimate that inflation of over 7% in the second half of this year would lead to a monetary policy-induced recession in the second half of 2023, as the Bank of Canada would need to increase their policy rate to 4.25% to return inflation to a 2 to 3% target. So they also explore the impact of a possible demand-driven recession on the pace of tightening. Knew certainly that a recession would occur in 2023, it would really only need to raise its policy rate 2% rather than 3 or 4% and keep it at that level. Obviously, this is not a foregone conclusion, but we do know that companies like Target are telling us now that they have excess inventory. Where else is this going to show up in the economy where we're going to see excess inventory? I don't know if this is what's happened there or if this is just Elon twittering away, but Elon did talk about reducing Tesla staff 10%. I would presume that Elon has a very good grasp on the upcoming economics. I mean, they are selling their vehicles anywhere. I think they've sold out for this year already, at least on the Y and 3. So they could be looking at that and saying, ooh, we're seeing orders fall coming into the new year, which would lead them to believe that we're already starting into an economic recession, right? He just tweeted that they're going to reduce their workforce 10%. Is it that he's predicting a recession, or that he's just pulling the Jack Welch School of Management where it's fire your lowest 10% every year? I don't know. Obviously, you'd have to ask Elon, but they definitely have a lot of numbers. They would have a lot of data. They would know what definitely would be happening. And it just might be that it's China, and they are, we just saw another lockdown today in Shanghai and parts of Shanghai. So who actually knows what's going to happen? I mean, time will tell. By the way, economists are always wrong. They're wrong 100% of the time, all the time. They do have good knowledge, and it's good to listen to them because, well, I'm not wrong all the time, but the 1% of the time that they're right most of the time. They just can't predict their timing, right? So they can't predict it's going to happen this time. They might be 6 months, a year out. Obviously, there are other factors in play. What if the government does some intervention? We all know that housing prices have gone down 20% since the peak, but that hasn't affected the cost of housing because mortgage rates have gone up from 1.4% to 4.2%. So it's still costing people the same amount or more money to buy a house right now. To conclude all of this, there's two ways I think we see a recession in Canada. I think number one, that the Bank of Canada raises rates too quick, too fast, and they plunge the economy into a recession. Number two, we see a demand-driven shift. So therefore, we've lowered demand enough. Now we have more inventory than we can sell. And I'm looking at obviously job markets and all these types of things. Employment growth is massive. There's still tons of people looking for workers out there that nobody wants to work. I mean, I pass by every store, every business, they have a help wanted sign up. So from that standpoint, I mean, we're not seeing real wage growth in comparison to inflation. So, I mean, it's one of those things. This is a very, very tricky situation, which we'd hope the people at Bank of Canada were super smart and they were taking all these things into account. Their track record hasn't proven that they're that smart. Time will tell. Comment down below. What do you think is going to happen? When do you think it's going to happen by? And you guys should definitely come out to our meetup Monday, June 20th at 7 p.m. at Caro on James. And as always, this video is brought to you by Loeffler Real Estate Services. If you're looking to buy a home, sell a home, or invest in real estate, definitely give us a call. Also, we're now licensed out in Alberta to help you buy apartment buildings there. So reach out to us on Instagram. Thanks, everyone. Catch you next time.